Minutes to the Federal Reserve's last meeting show that the committee believed that further tightening would be appropriate if progress towards inflation was insufficient. It's a bit of a more dovish take on the reasons why the Fed might hike again. All judged it critical for policy to be kept, quote, sufficiently restrictive and remain restrictive for some time. The committee was seen in a position to proceed carefully, so no big hurry on the part of the committee to do anything, because policy was seen as restrictive already and was seen putting downward pressure on the economy and downward pressure on inflation. Financial conditions, they said, had tightened significantly, and in the meeting, the officials debated the reasons for the rise in yields, the persistence of how long it would stick around, and the potential impact on monetary policy. You've heard that debate about higher yields doing the work for the Fed. This was part of the debate they had at the Federal Reserve meeting. Further evidence was required, however, that inflation was on a path to a 2% target, and there was only limited progress, they said, in bringing down core services inflation, though they thought they had seen much better inflation results in the goods sector. The risks to the outlook, they said, were more two-sided, including demand and supply remaining out of balance, persisting geopolitical risks, as well as oil markets being among the risks they discussed. Supply and demand, however, were seen coming into better balance. Inflation, they said, had moderated but remained unacceptably high, was the word they used. The labor market remained tight, but they saw wages moderating, and there was concern they remained too high at the moment for the Fed to be on target to its 2% target. Several said there was more upside to the consumer. Maybe they had more resources than originally thought. I'll leave it there, guys, except for that one phrase at the beginning that I mentioned: further tightening would be appropriate if progress towards inflation is insufficient. Seems to put the onus on the need to hike again, needing more data to hike again, rather than the bias to hike again and being proved why they shouldn't do that.
Indeed.
Tyler?
All right, thank you very much, Steve Liesman. And stay with us there as we get a little bit more reaction to the minutes. Let's bring in another Stephen Stanley, Chief U.S. Economist with Santander. Stephen, welcome back. Good to have you with us.
Thanks, my pleasure.
What do you pluck out of
well, it just seems like
this big turkey?
This is a case where 3 weeks is a long time, right? Because the Fed was having this extensive discussion about tightening financial conditions, and now guess what? We're right back where we were before the September meeting. So tightening financial conditions not really much of a consideration anymore. I think from the market's perspective, the market just wants to be done with the Fed hiking, and the Fed keeps saying, not so fast, we might go again, but the markets are not buying that.
They seem to be sort of playing out the clock here a little bit, just talking as though, not suggesting that they're going to raise rates, but leaving that option open.
Exactly. And I think the problem for the Fed is they don't want the markets to conclude, as they have over the last few weeks, that they're definitely done, because you see what happens. The stock market goes wild and bond yields go down, because everybody's then, the minute we stop talking about Fed hiking, markets want to go to the next thing, which is when are they going to begin to ease?
Let's talk a little bit about housing, which certainly has been affected by tightening financial conditions. It is in a slowdown, and housing is so central to the American economy. If housing slows, is it really realistic to not expect some sort of recession or stall in economic growth?
Yeah, well, this is a great example where tightening monetary policy hits different parts of the economy at different points in time. And the bulk of the drop in housing activity happened last year, right? So the consumer was powering the economy through last year and through much of this year. All the while, housing has had most of its correction already. I mean, we saw a huge decline in housing activity in the second half of last year. And then so far this year, it's been closer to flat. So, I think it's going to be tough for housing to rise much from here, as long as mortgage rates are where they are. But it feels like we're kind of going along the bottom at this point.